Hello, everybody. My name is Steve Maldonado. Welcome to our Wednesday workshop at 1. Today, we'll be talking about the benefits of mortgage note investing in a self-directed retirement account. Just a little disclaimer, NuView is a passive IRA custodian. That means that we do not provide tax or legal advice. We are not registered investment advisors or CPAs, so you will always need to seek your tax advice through those entities. We custody IRAs, ESAs, HSAs, and solo 401ks that hold alternative asset investments. So what is a self-directed IRA? Self-direction is a marketing term, which basically encompasses all investments made by yourself through your IRA. Our niche is alternative investments. So we help people access the money in their IRAs and 401ks to invest in alternative assets, tax deferred or tax free. Like I said, some of the things that we do here are allowing our clients to diversify their portfolio by investing in these alternative assets, tax deferred or tax free. So we'll talk a little bit about the types of accounts that we offer and more so the benefits that come along with them here in just a second. So we custody a number of plans here at NuView. The first being a traditional IRA. Traditional IRA is one of the more common IRAs that we hold. Most commonly, they come over from a previous employer plan, something that somebody has held for a long time, a 401k that's then being rolled over into that traditional IRA. And for that reason, it's one of the more common plans, again, that we custody. Traditional IRA contributions are made pre-tax. So you are taxed once you take distributions from the account after the age of 59 and a half. You can make an annual contribution to this account of $6,000 a year, and then an additional $1,000 catch-up contribution after the age of 50. Conversely, the Roth IRA is a post-tax account. So you make contributions into that account and you pay taxes on the contributions going into the account. Similar to the traditional IRA, you are able to contribute up to $6,000 a year with the same $1,000 a year catch-up contribution at age 50. Moving on to our employer plans, we also custody employer plans for self-employed individuals or people that have small businesses. The most common plan that we custody in this realm is the solo QRP or 401k. And again, that's for small business owners. And these are for small businesses that have no common law employees, so have nobody working for them. The benefits of the solo QRP are that you're able to make much higher contributions than that of the traditional or Roth IRA. You are able to make a contribution on the employee level up to $19,500. And then you are also able to match that as the employer up to 25% of year one income, but I believe it's an additional $40,000 to not exceed the $61,000 here. And then as part of that, you can also make an additional $6,500 catch-up contribution over the age of 50, and then take distributions from it at 59 and a half. Other benefits of the solo is if you are investing in debt leveraged properties or you're doing real estate investing, you do not pay UDFI tax. That's the undirected debt leveraged finance income tax that many people pay on these real estate investments. Through the solo QRP, that would be a tax that you would not be responsible for paying. You can also take an emergency loan from it up to $50,000, not to exceed 50% of the total account value of your solo 401k. You are responsible for paying that loan back to the 401k with interest. But in this instance, the beneficiary of that plan is yourself. So you'd be paying yourself back with interest. Moving on to the SEP. The SEP is another employer plan offered by NuView. It's similar to the solo. It is a pension plan rather than a 401k plan. You can make a $61,000 contribution. So it does have some high contribution limits as well. It's one of the benefits of the SEP. There is no catch-up contribution. So like the solo 401k, where there is a $6,500 catch-up contribution after the age of 50, this does not exist with the SEP IRA. The simple IRA is another form of employer plan, which allows you to contribute, but also do an employer match. This simple IRA is a plan that's offered to our small business owners that do have employees. You can make up to $14,000 a year's worth of contributions, and then you're eligible for a $3,000 a year catch-up contribution after the age of 50. Some people aren't aware of this, but we do custody education savings accounts and health savings accounts that you can use to make investments as well. So the ESA is an account that you can make contributions to benefit your child when they do decide to go to college, or if they do decide to go to college or pursue a higher education. These accounts can be used to pay the educational expenses. And the main benefit of this is that, again, they are tax deferred investments. You can make a contribution up to $2,000 a year to that, and contributions must be made prior to the 18th birthday. But those can be used for a variety of expenses in college, or when, again, you're pursuing that higher education. You can pay rent with it, you can pay for books, you can pay for laptops and electronics, you can pay for anything related to your education. And then next we have health savings accounts. So these accounts are set up to allow you to save for, those unexpected circumstances, and also for just your regular preventative procedures. You can contribute by yourself to this account up to $3,650. And if you have a family plan, you can contribute up to $7,300 with a $1,000 catch-up contribution after the age of 55. And like the education savings account, the money going into it is post-tax, and then actually coming out, as long as it's used for health expenses or health-related expenses, then it's tax-free as well. So I myself have a health savings account. You do have to have a high deductible health plan for that. So depending on what coverage you have, this might not be available to you, but it is something that we custody, and something that you can use to make passive investments. So I mentioned earlier on in the presentation that we are a passive IRA custodian for alternative investments. At this point, you are probably wondering what alternative assets and alternative investments are. So we see our clients invest in a variety of investment opportunities, but some of them are shown here. We see a lot of people investing in private entities, so LLCs, LPs, joint ventures, trusts, etc. And then also doing a lot of real estate investing, so foreclosures, tax liens, apartments, real estate options. And then more recently, with the popularity of crypto, we've seen people use their IRAs and 401ks to purchase crypto, buy into crypto funds. So funds that invest in crypto and all types of coins, Bitcoin, Ethereum, Litecoin, etc. Promissory notes, so secured notes and unsecured notes, precious metals. There's a variety of investment opportunities, and that's one of the main reasons that we do these Wednesday workshops, is to expose our clients to the variety of investment opportunities that they have access to and may invest in using their self-directed IRA, 401k, tax-free and tax-deferred. So without further ado, I'd like to introduce our guest speaker for today, Jamie Bateman. Jamie is the founder of Labrador Lending and has been investing in real estate for over 10 years now. More recently has been successful in investing in mortgage notes, and we're excited to bring him on today to talk a little bit more about that. Joining him is his business partner, Andrew Smith. So I'll allow them to take it over from here. Hey, Jamie. Hey, Andrew.
Hey, thanks for the introduction.
Yes, thank you very much. We need to update my bio a little bit, but no, thanks for having us. Really appreciate the opportunity to talk about mortgage notes and why notes make a great kind of marriage with self-directed retirement accounts. So we're happy to be here. Thank you. So can you see that okay? Looks like it's a little bit off the screen, but I think it's fine. Benefits of mortgage note investing in a self-directed retirement account. So a little bit about me, former collegiate athlete, former lacrosse coach, former U.S. Army captain. I served in Iraq for a year. Happy to have served our country and happy it's behind me. I was on the Good Deeds Note Investing podcast for almost 2 years with my business partner and a couple of other ventures, Chris Seveny, manager of Labrador Lending. You can see the rest here. We also started a loan servicing company last year, and I managed 2 mortgage note funds as well, one of which Andrew helps me with, or really I help him with, the Integrity Income Fund. So I started working in real estate. I worked in the early 2000s before the crash in 2007, 2008, 2009, worked in the title and mortgage industries for a couple years, realized how little I knew about title insurance and mortgages and all that stuff, and didn't get active in the real estate investing space until about 2010, which is when my wife and I purchased our first rental property. In early 2018, I transitioned, held on to the rental portfolio, and in fact, that's still a key piece to my own personal portfolio, but my focus since 2018 has been on mortgage notes. So since early 2018, I'd say 95% of my professional focus has been on mortgage note investing, which we're going to get into. Andrew, can you give a 30-second bio?
Sure thing. I am not the fund manager, so I don't have a slide all to myself. I'm an asset manager here at Labrador Lending. I became interested in the alternative investment space. I was a product manager at a software company, and one of the areas I was in charge of was the alternative investment area of the platform. So started researching private equity, hedge funds, and real estate, became really interested in that, more so than writing, more so than all the code that went into the software. And I was researching investments, and I found Jamie's firm, and I said, hey, this is what I'm up to. This is where I think I can contribute. And I've been working for most of this year as an asset manager for different funds. So we have one fund that's been raising capital lately, but there's some other assets. Jamie's involved in 2 funds. So there's more than enough work to go around, let's say, because the asset we can talk more about the asset management side of the business, but I'm enjoying that. It's a great team. We're spread out remotely, but there's 4 or 5 of us, and we continue to learn and raise capital from investors.
Yeah, truth be told, I wasn't looking for help when Andrew reached out, but I don't know where I'd be without him. What is a note? A note is a promise to pay. And so, essentially a note spells out the actual document. The note itself spells out the terms. It's very basic. Usually it's 3 pages, spells out the terms of a loan. So, the interest rate, the number of payments, et cetera. So that's the basic answer to what is a note. Then you get into when we deal in secured notes. Steve mentioned unsecured and secured notes. We deal only in first position mortgage notes. So what is a mortgage or a deed of trust? It is the security document that collateralizes the note. So what that does is it links the note, which is the promise to pay, to in our case, real estate, typically single family residence. So that collateral, that real estate becomes the collateral through the mortgage or the deed of trust. And so we purchase mortgage notes. We don't originate notes. That's not part of our wheelhouse. It's not what we do. We purchase previously originated mortgage notes. And by doing that, as the investor, we essentially become the lender or the bank. Now, again, we did not actually originate that loan, so we're not technically a lender or technically a bank, but it's very much the same thing. We all of a sudden have all the rights and interests that the lender or the bank had. So investment performance is driven by due diligence at the purchase, which there's a lot there that we're going to probably just gloss over here. There's a lot to this business as far as being an active note investor. And as Andrew can attest, there are many moving parts to this business. Anything to add to this slide, Andrew?
No, I think that's the gist of it. Yeah, I think we're going to drill down more on the actual mechanics of where our wheelhouse is on as far as what assets we prefer to buy and what assets we think we can make a return for our investors with. But this is the general gist of how the loans work.
Exactly. So the basics, you know, on Steve's slide earlier, you had real estate as the second category, and then promissory notes were the fourth. And I know those were just kind of example categories. Is mortgage note investing a real estate niche? I would say yes. Some people argue it's not. It's kind of a, you know, blend between, it's kind of its own little separate niche within real estate. And you can do note investing outside of real estate notes as well. Like I said earlier, we focus on mortgage notes. So we are all about real estate and understanding the real estate that's backing up that actual asset that we purchase, or that investment that we're buying. So again, based on a promise to pay and backed by real collateral. Why combine mortgage note investing with a self-directed account? That's really the bread and butter of this presentation here. To me, the number one reason is what NuView and other custodians offer is a way to invest in notes while solving the tax problem. So we're not going to get too far in the weeds on, you know, all of the benefits or the downsides to note investing, but we will hit on it a little bit. There's no asset class out there that is, you know, perfect. Every asset class, every strategy has a drawback or two or more. And with mortgage notes, one of the downsides, you could argue, is that there's no special tax treatment. So if you're buying a rental property, for example, if you're investing in active, hard real estate, I should say, typically there are tax benefits written into the code. Depreciation is one that comes to mind, right? So those who are familiar with rental property investing, for example, they're familiar with that tax benefit that you get whether or not you're using a self-directed account. And again, none of this is legal or tax advice. This is just educational and experience-based information. So with note investing, there are no inherent tax benefits. And so what do you do about that? Well, one thing you can do is invest in mortgage notes through a self-directed IRA or self-directed retirement account that's not an IRA. Performing notes can be passive, and we're going to get into whether note investing is passive or active. But if you're buying performing notes, and there are other ways to invest in notes as well, in your self-directed retirement account, it can be a tax advantaged passive way to invest. And again, active versus passive. In our world today, we like to put things into one of two categories. It's either active or passive, and really there's a spectrum. And same thing with performing versus non-performing. We're going to get into that a little bit. Performing essentially means where the borrower is making loan payments on time. That's for the most part, I think that's what most people expect. If you own your own home, if you're watching this, you own your own home, you probably make most of your mortgage payments on time. In this space, we deal with oftentimes borrowers who have fallen behind. Bad things happen to good people. People face challenges in life. And so we deal with a lot of non-performing loans as well. That's kind of the very basic difference between performing and non-performing. We've got a blog post on our website that addresses the active versus passive question or spectrum, if you will. Goes into a ton of detail on kind of the spectrum of active to passive with note investing. Frankly, a lot of gurus out there like to sell, the dream that note investing is passive and it's mailbox money. And, that's true. That can be sold with real estate and other things as well. Well, notes can be passive, but they can also be a lot of work. So anything to throw in there, Andrew?
No, I would just like to recap before I say anything, the disclaimer Steve said at the beginning. Nothing we say can be construed as tax advice or investment advice, but just a lot of investors who have a self-directed IRA actively think about asset allocation and what kind of investment goes in what kind of account. There are taxable accounts, brokerage accounts, and things. But what we've heard from a lot of our investors is that mortgage note, the interest income is taxed as ordinary income. And so to defer those consequences, the self-directed retirement account is a great home for mortgage note investments. And so we just like to, that's why we're sharing this information to you today. And also back to the first slide, this is not a common asset class. So even everybody's heard of real estate, but not a lot of people have in-depth familiarity with some of the economics and how these investments operate. So we're kind of sharing both of those things, just an overview and why it might be really a great fit for a self-directed IRA.
Andrew, can you run through this slide quickly?
Sure. There are many advantages to investing in notes. It's not tied to Wall Street. So I think a lot of us got our investing journey started on publicly traded stocks, perhaps, or maybe some mutual funds that came with your 401k enrollment. This isn't tied to Wall Street. This is tied to single family residents, owners of single family houses paying their mortgage on time. They have an incentive to stay in their home, and we work with borrowers who want to stay in their primary residence. It diversifies your income stream, again, away from government bonds as interest rates rise, or again, diversifying away from publicly traded equities or even publicly traded real estate investment trusts. This is a less volatile asset class. Things are slower moving, which is kind of an advantage here. So if some economic news comes out, our mortgage notes don't really change in value. They're still the same because the borrower still lives there and they're still paying their bills. One of the things that drew me to this opportunity, especially, and I got this from the Good Deed Note Investing podcast that Jamie co-hosted, is it's a win-win for the borrower and the lender. In that, what we can do is, as a specialty lender, what we can do is adjust the terms of the mortgage to keep the borrower in their house, and that's a win-win. They get to stay in their house and they can improve their credit score, and then if they continue to pay, the value of that note increases for our fund. And we can deliver attractive returns while preserving investor capital and keeping the borrowers in their home, because we have many options that we have, and we can go in those a little more detail. And control and security. We can invest in a collateralized asset that many people understand. Hey, it's backed by somebody's primary residence, and there's an incentive to stay in your primary home. And everybody, a lot of us are homeowners. Some of us are renters. Some of us are homeowners. Some of us are renters who want to become homeowners. So we all, I think, understand that pull, and it's recession resistant because a lot of people will sell their toys before they move out of their primary residence. It is location independent. We have the ability to not only run a distributed remote team and find the right team members to move forward in a productive way, but we can invest in mortgage notes in all throughout the South, the West, Midwest, Upper East Coast. We can invest anywhere inside the United States. That's our focus. There are a few states that aren't lender friendly that we avoid, that we don't actively hunt for bargains in, but really the entire United States is accessible to us. Jamie, do you have anything to add to that?
Yeah, that was really good. As far as risk, right? There's risk in every investment. There's always risk. But I found it interesting when I started getting into real estate investing and mortgage note investing, when you'd share with a coworker or someone. I ended up quit my job in March, but when I was at my job, I'd talk about what I was doing on the outside, and the most common reaction was, "Oh, that's risky," and it's like, well, maybe it can be, but at least with this asset class, there's collateral, right? And so that's where you get into you're avoiding the market volatility, but it's backed by collateral. So is the stock market risky? I mean, there's no collateral. It can go to zero tomorrow. So these are some of the things that we like about notes. And like we said, there are some drawbacks, but these are some of the main reasons that I got into mortgage note investing and why I'm still active in it. Again, why note investing? Here we go, presented in a different way here. Discounted pricing at purchase. So if I'm buying a note has a principal balance of $100,000 as an example, typically we can buy that note for anywhere between $50,000 to $95,000. There's almost always a discount at the purchase. So that's a huge benefit there. If, for some reason the borrower then pays off the next month, pays that loan off, we just made a profit. So discounted pricing, collateral, diversification, control. We have multiple exit options if the borrower doesn't perform. There are many, many different scenarios. You never know exactly how the note's going to play out for sure, but if you purchase right and you do your due diligence up front, you're not typically backed into a corner, and you do have a lot more control than you do. And again, I've heard the analogy, like if you buy Apple shares of Apple stock, nothing against Apple, but do you have any control over the decisions that are made? No. So here we have kind of hands-on, ground level control of how we execute on, and how we manage these assets. Numerous access points. We purchase first lien mortgage notes for many different reasons. One is that we're closer to the collateral, and another is that there are more of them out there, frankly. And another is that it's just, I'm familiar with real estate. It's something we understand, but you can get into second lien mortgage notes, land contracts, which we do purchase. And that's we'll have to do another webinar on land contracts. You can read the rest of these. No tenants, toilets, and trash. That's a big one. So like I mentioned, I have a rental portfolio. I like rental property investing. Yeah, but even though I do have two different property managers, I still end up having on some level to deal with tenants, toilets, and trash. With notes, you're dealing with the paper, and you're dealing with your laptop and a phone. And so, yeah. So number 11 is pairing with a self-directed retirement account. It really goes very well, which we're going to get into. Note fund benefits for passive investors. So like we touched on, we run two different mortgage note funds. One is more of a non-performing note fund. The other is more of a reperforming or performing note fund that Andrew is heavily involved in. And that's the one that is open for investors currently. But fund investing has a lot of benefits as the investor, right? It's much more passive than buying a whole note or buying non-performing notes. So if oftentimes it's for accredited investors only, but if I'm an accredited investor, I can take my self-directed retirement account, the money that's in there, invest in a mortgage note fund, and all of a sudden I have, an asset management team running the note fund for me. And my investment is diversified across geography, like Andrew talked about already, across multiple states, borrower type, many different borrowers that we deal with, performing, non-performing, and then again, just the number of assets. So, with say a multifamily syndication, for example, nothing wrong with that, and that asset class or that strategy. Oftentimes with that, you're buying one property, and usually the operator has the property identified ahead of time. Hey, we need to go raise capital to make this purchase. In our case, it's switched. So when we run a fund, we go out and raise capital, then we actually go out and buy mortgage notes, and we'll end up having, anywhere from say 10 to 50 mortgage notes in a fund. And as an investor, you're spreading that risk across many, many different assets. For the fund investor, using their self-directed account or not, there's very little time commitment, if any. And once you get your documents set up in the beginning, there's not really much to do. So it's quite passive. The fund manager tracks payments, property taxes, insurance, and I can tell you, and Andrew can tell you, there's a lot more minutia and detail, and just a lot of moving parts to mortgage note investing that you might not always hear about. It's one of those things, just tracking homeowners insurance, for example. No one really enjoys tracking homeowners insurance, at least no one I've met. But if the borrower doesn't pay their homeowners insurance, yes, we can go out and put forced place insurance on that property. But what if we don't know about it? And what if we missed that for a week? The property didn't have insurance on it. Property burns down. That, like I said, was our collateral. That's not good. We need to track that actively. And we have processes in place to actively manage the tracking of homeowners insurance. It's just one example where, you as an investor may not want to get involved at that level, especially if you're managing more than one note. But we handle that for you. And again, we have third-party bookkeepers and CPA, and so we're plugged in with the vendors and servicers and all that stuff. So it's not something that as a fund investor that you would need to get involved with. And we would also handle loss mitigation, borrower negotiation through the servicer, and compliance. Anything else, Andrew?
No, I would just like to say that, our systems are finely tuned to deal with 10, 20, 30 assets. This is nothing that's going on with these properties or anything that anybody on this call couldn't handle themselves. But when you scale to multiple assets under management, it just becomes a lot. I'm sure a lot of us are homeowners on this call, and you probably if you get a piece of mail from your insurance company, you probably open that and deal with that. A lot of our borrowers don't do that. So we have to kind of be a second set of eyes on everything going on with the asset. And we have systems in place to go through it on a regular basis, make sure all the I's are dotted and all the T's are crossed, and make sure our investor capital is protected by the right insurance and right collateral in the right place and things like that. So our systems are just ready to scale, and that's part of what we do as a fund operations team.
Yep. The other thing I'll just quickly mention is the funds that we run. This is not a commercial, just letting you know the funds that we run, we don't take out leverage. So you wouldn't run into any UBIT or any of those issues if you're using your self-directed account. All right, we have 2 case studies here. We could put together 50 case studies. These are just examples. These are real examples. And both of these case studies we did loan modifications on. So it's just one way that you can exit a non-performing loan, or I guess make a non-performing loan profitable. So in this case, we purchased this loan, and the borrower was actually 6.5 years behind. You can see the purchase information there. The interest rate was over 12%. I think originally it was actually a HELOC that had become a first, and there were $26,000 in arrears. So way behind. Well, honestly, this was one we kind of somewhat got lucky on. The purchase price was very low because the borrower was so far behind. However, there was communication with the borrower, and that's critical. And so a lot of this, when you're managing assets, when you're determining your exit strategy, has to do with whether there's, what's the borrower want? I mean, we don't control everything. We do have some control, but a lot of the your planning and your strategizing has to do with whether or not there's communication. Well, in this case, immediately the borrower said he wanted to speak with the lender. His loan had transferred multiple times. He didn't even know where to make his payment. And so we had a property inspector go out to examine the property during our due diligence, and the borrower, the homeowner, made contact immediately saying, "Hey, I want to work something out here." Well, hey, that's a a clue that he wants to stay in the property, and that there might be something. Almost 9 out of 10 times, working with the borrower and exiting through the borrower versus exiting through the property is going to be more profitable. And in this case, it was. So I'm not going to read all the numbers here. The point is, we were able to do a loan modification, kind of reset, lower the interest rate, actually lower his monthly payments, extend the maturity date, and get him back on track. And I will tell you that since we did this 2 years ago, whenever it was, he's been on automatic ACH and literally has not been a day late on any payments. This is not always the case. Do not take, I'm not saying this is 100% of the time what's going to happen. But in this case, the numbers were very good. And actually we ended up buying this one for our fund.
And I'd like to, can we go back to that slide? I
Yep.
just want to talk about something that was a little counterintuitive for me as new to the space. By, when the borrower wasn't paying, by taking all the arrears, all the money that they owed us and adding that to the end of the loan, but still lowering their payment to the point where the borrower could successfully make that payment every time, that was more valuable to the fund, to the investor, than just going to foreclosure and trying to get the property back. Additionally, it was more valuable to the borrower so that they could improve their credit rating and make their payments. And at the end of the day, if they're a better borrower, they're more likely to get refinanced. And reminder, since we bought this loan at a discount, if they refinance or move out to a better, from a starter home to a second home or a dream home, we get paid the full amount on the note, not what we paid for it. If we buy it at 60%, we get paid 100% if they refinance and move out. And by improving their ability to pay, we make that much more likely for them to achieve if that's what they want to do. So that was, kind of counterintuitive for me, but a win for the borrower and a win for the fund as well.
Yeah, absolutely. And these two case studies we're going through today are absolutely win-win-win all the way around. Just to reiterate, they're not always like this. More often than not, we do make money on a deal, but sometimes we lose money, and sometimes you could view it as the borrower lost. But the fact is, we're not in the business of trying to kick people out of their homes. It's much more profitable to work with the borrower, see if you can restructure things and keep them in their home. Taxes are now being paid, property taxes, so it's good all the way around. And like Andrew said, in this case, we raised the principal balance actually. So we recapitalized some of those arrears, but we lowered the total payoff for him. And so we forgave some of what he actually owed, extended the term, lowered the monthly payments, and check with your attorney. This is not legal advice, but this one's been a win-win all the way around. Second one that was kind of similar in Birmingham, Alabama. You can see the numbers here. It was a joint venture that I did with a partner, and excuse me. And so it was a sub-performer. So, definitely more on the non-performing side of things, but this borrower, she was, if I recall, about 2 years behind, but she was making payments. She was making monthly payments every month. So clearly she wanted to stay in the property. And so you can see the numbers here. The total payoff at purchase was over $75,000. We ended up doing a loan modification and lowering her interest rate, lowering her monthly payment. And then, so we had purchased this note for $26,000 because she was so far behind. We ended up selling it for $50,000 after we held this for about a year. And this borrower made those payments to us for that year as well. So that 15%, if you see sold for $50,250, and you see that 15% yield to the buyer. So that's when I sold this note to a note buyer. That is the projected yield to that buyer at that time. So it's still a good price for that buyer. So not only did the borrower get caught up, she's making payments. She's in a much better situation than she had been in. We made money on the sale along with the payments that she made to us. And then the buyer of the note, when we sold it, also is continuing to make money through her payments. So yeah, win-win-win in this case. Here's some more of the specifics on this one. So technically to us, there was, an infinite return because we didn't have any money in the deal, but, then again, yield doesn't, buy you dinner. So moving right along, five key decisions for active note investors. Okay. So this is if you decide you want to use your self-directed account and you want to go out and buy a mortgage note, you're not accredited, or you can't find a fund that is for non-accredited individuals. You don't want to buy partials. That's a whole separate topic. You've decided you want to be an active note investor. These are 5 key decisions that I came up with as far as, I do mentoring as well. And a lot of times, in some, it's not always in this order, but these are questions you need to answer before you just jump into this space. How active or passive do you want to be? Do you want to buy, a couple performing notes in your self-directed account? That's not going to require that much time. Or do you want to build a portfolio and build a business? I mean, that's something, you obviously can't build a business in your self-directed account. So that's, it's just a decision you got to make. How much time do you have to devote to this, and how much energy? First or second position, do you want to buy first mortgages or second mortgages, or both? A lot of people do both. Like I said, we focus on firsts. What states are you going to invest in? Frankly, this is something that I underestimated initially. Everything varies by state in this space. I would say even more so than real estate investing. So it's not just, what's the market going to do? What are the economic indicators in that state? It's also, what are the foreclosure laws? What are the licensing laws to buy debt? Do you have to have a lender license? Are there notes available in that state? What's the pricing like? How long does a foreclosure typically take? What's the cost of a foreclosure? It varies wildly across different states when you compare states. So you kind of have to narrow down. Essentially, what you're doing here is building your buy box, which Andrew and I have recently been fine-tuning for our own fund. But I say, pick 5 to 10 states that you're comfortable buying in. Are you willing to buy CFDs or land contracts? Again, whole separate topic. Is that something you want to deal with? There's a lot, you can get them typically for a lower price point, but there's also strings attached, and there's more work and more liability with them, because actually you as the note holder, your name is on the deed. So again, not investment advice. I don't necessarily love buying CFDs in a self-directed account, frankly. So but that's a topic for another day. Performing or non-performing. Just real quickly, performing notes are more like a buy and hold rental property. You're buying for cash flow. You're buying for, hey, I want this 10 to 12% yield. You want payments every month. That's a performing note. Non-performing notes, think of those more like a fix and flip of a property. It may take 6 months to 3 years to exit that non-performing loan, but there's a clear entrance point and there's a clear exit point. So very different than a performing note. And it really depends what your situation is and what your goals are. Andrew, anything?
No, I'd just like to add the performing versus non-performing. There's also some gray area in between, because it's really all about how many payments have they missed, and did they make it up later? And there's gray area in there. Sometimes even the best borrowers miss a payment or two and get everything back on track, and it never happens again. Sometimes when they miss 1 or 2 payments, it's a sign of a bigger problem that isn't going to resolve itself without a loan modification or without some other intervention. So performing and non-performing, it's a little bit of a gray area, but we're raising capital right now for one that's more performing.
Yep. And we do buy across, we buy both. If you're going to really get into this space, you want to buy performing notes, I would say, because at least on some level, because you do want to have that cash flow, which is critical to running a business. You need cash flow to keep the lights on. Andrew, it looks like you need a little more cash flow.
Yeah, to keep my room is a little dim. I need one of those ring lights.
I'm joking, but we buy both. And so performing notes are great for cash flow. Non-performing notes are great for upside potential, like a fix and flip. Key decisions for passive note investors. How do you choose a mortgage note fund? I would say, and we can get into this, but the key thing really is identifying an operator or asset manager, fund manager who you trust, because although with notes you do have more control than maybe you have if you're buying shares of Apple stock, the truth is if you're investing in a fund, you do lose a little bit of that control. So you need to very properly vet the fund manager. And, that's a key thing. You want to vet who you're putting money with. Again, mortgage note funds, as far as, what's the fund structure, there's all kinds of details to get into. Are you receiving monthly payments, quarterly payments, annual payments? What's your time commitment? Is it 3 years, 2 years, 1 year? What's the lockup of your money? What's the experience level of the fund manager? What's the goal of the fund? Just lots of factors to consider. And then, performing or non-performing fund. Again, do you want upside? Are you looking for more upside? Because, we have both. We have two different types of funds. That our non-performing fund is closed right now as far as capital raise. But some people, if you're younger and you really want that upside, if you're retired and you're used to getting a paycheck, maybe you want that performing, that cash flow. So it's really based on your own situation. And so number 3 is kind of self-explanatory, and fund due diligence. There's oftentimes is a PPM, and this is a whole, you can get into the whole Regulation D, 506C, all the different types of funds and legal jargon, which this presentation is not really centered on. It's not normally required to have a PPM, but our funds have a PPM, a private placement memo, so you can read through that if you're actively looking at funds. And then the subscription agreement and the articles of incorporation are critical as well. So top things to consider if you're looking at a note fund: competent and experienced manager, transparency, communication is critical. You don't want to invest with someone who is just, going to just not talk to you or not. We do quarterly updates. We have a portal where the investors can log in and see which assets we own, check on their own individual investment, and that kind of thing. Economic conditions, upside potential, management fee, that gets the structure of the fund. So these are several things to consider when assessing and choosing a note fund. Andrew, anything?
No, I think you covered it pretty well. It's a lot like any other asset management decision, reviewing funds. In the private space, it's a little tougher because it's not like a mutual fund on Morningstar, or you could go to Vanguard or Schwab or Fidelity. So it's a little more time consuming, and it's a little more important to get in depth with the reputation of the manager.
Yeah, absolutely. Ask around.
Yeah.
Stay connected with us. So labradorlending.com. We've got a lot of free information there on our website, a lot of blog posts. We've got our ebook, Power of Mortgage Note Investing. And to be perfectly honest, we toyed with charging for it because it's about 75 pages and it's chock full of information. It does not have certain things in there. It doesn't go into depth on due diligence, for example, but there's a lot that's covered in that ebook. I do mentorship. We have our Integrity Income Fund for accredited investors, the Good Deeds Note Investing podcast. So Chris Seveny and I, Chris started the Good Deeds Note Investing podcast about 4.5 years ago. He asked me to join him about 2 years ago. And so we did that together weekly for the 2 years, had a blast. We got a lot of very positive feedback, and if you're interested in mortgage notes, there certainly are other podcasts out there, but I think I'm a little bit biased, but I think ours was the best. There's a lot of good content there. Chris rebranded it. I have my own podcast now, which is the bottom bullet there, Adversity to Abundance. It's not note investing specific. So Chris's new podcast is now called Creating Wealth Simplified. So we have a Facebook group you can check out. And so the one thing with the Good Deeds Note Investing podcast, about 16 months ago, I interviewed Jason DeBono, who is Steve's boss, and he is the president of NuView. And that was a eye-opening episode. I think it was March of 2021. I learned a ton about different, like EQRP and different self-directed account types and different ways to invest in different things. I know Jason has invested in notes himself. And, we always say self-directed IRAs because that's the probably the most common, account, I would guess. But there's so many more nuances to it that I can't talk about because I don't know quite as much as Steve does. But anyway, that's definitely an episode to check out. I highly recommend it. And here's some other ways to get in touch with us. Andrew, anything?
No, I think it's we'd love to turn it back over to Steve and see if there are any audience questions that we could answer.
Great.
Absolutely.
Thank you guys so much, Jamie, Andrew. Great piece of information here. Thank you so much for your presentation. And like Andrew said, we're going to go ahead and open up the floor for Q&As. I think we received a couple questions during the presentation, so I'm looking here. We have a question from Daryl Haben. He says, are you purchasing distressed notes directly from banks? And to follow up on that, how do you source notes for acquisition? Do you look at assets in Oklahoma?
The first answer is no. This is something that it sounds good. I would like to, but the reality is it takes a little bit of time for notes to kind of trickle down to where we are. In our space, I don't know of anyone who's had real, sustained success reaching out to banks and actually buying distressed debt. If you have a connection, Daryl, hit me up. I'd love to talk. But it's not something that's been fruitful for us. Typically where we're buying from, which is more to the second question. And this is the $1 million question. And I'll be honest, this has been probably the biggest challenge in this space in the last few years is finding deal flow. So when you run a business, whether it's mortgage notes or not, especially an investment based business, you typically have three things that you're juggling. One is access to capital. So in our case, we have funds that we raise capital for, but we also may have our own money or joint ventures or other ways to get access to capital. The second piece is deal flow, and that's been the hardest one right in the last few years. So it's a very inefficient marketplace, rather, and you need to network and it's not as easy as it may sound to find deals. And then the third piece is managing the assets. That's that's where you can do very well if you stay on top of things and you know what you're doing. So that's a whole separate presentation, is where do we, how do you source notes? It's definitely been a challenge. But once you're plugged in, I'll tell you one thing that I overlooked initially is other note investors or just small note funds that maybe the fund is closing and they have to liquidate. Well, that doesn't mean there's anything wrong with the assets, the notes themselves. It's just the fund is selling their assets. So, or maybe a small time note investor is changing their life, their life changed, right? So they just want to get out of notes, or they're selling a few notes or whatever. Other note investors is a great, or other note funds, two great sources. What returns have you seen? Oh, sorry, Steve, did I?
That's okay. Yeah, you're more than welcome to read them out and answer them as well.
Also, we would happily look at Oklahoma.
Sure.
Some seller finance sellers. So seller financing is if somebody owns a property outright, they're willing to sell it to somebody and the buyer pays them over time, not getting a mortgage from a bank. But oftentimes the people that do seller financing eventually change their minds and would rather have a lump sum and sell that off to somebody. So just by Jamie's presence in the industry, some people Google search him or network to find him. And we look at some seller finance deals, and Oklahoma is absolutely within our buy box. So if you have any seller finance or any notes in Oklahoma that you're looking to sell, by all means, the website is there, and reach out to us.
As far as the third question, what returns are we? I end up saying it depends as much as an attorney says it depends, but I've seen anywhere from 6 to 10% if you're investing, just for a cash flow performing note based fund. That's your typical kind of return range annually. You know, our performing note fund offers 8%, and that is for accredited investors. That's fairly standard. A couple of things that may be different about ours. One is that it's a 12-month lockup, so it's generally on the shorter side. You can get your money back if you want fairly quickly, and then we do have monthly payments. But I'm personally invested in a fund that pays 10%, but it's actually today is the last day for that, from what I understand. I had to check the date.
And then I think that
yeah.
Sorry, Jamie. But I think that you mentioned it within your last answer. But you do not accept accredited unaccredited investors in this fund, right?
Not in this fund. We've worked with. We occasionally sell partials, and we do work with non-accredited investors. But unfortunately, and I have an opinion about all this, but unfortunately, from a business standpoint, it just makes a lot more sense for us to work with accredited investors for our fund. And so I wish some of that would change, as far as but I don't write the laws. So yeah, our fund is for accredited investors only.
Okay, great. Well, all great questions so far coming in from our participants. I think we still have a few more minutes here, so please submit some additional questions if you have them. There is a Q&A section down in the Zoom if you want to use that to add some questions here to our Q&As. But fantastic. If there are no more Q&As, if you guys are interested, again, as Jamie and Andrew said, about learning more about Labrador Lending and their opportunity, go to their website, Labrador Lending, find them on Facebook, Instagram, Twitter, LinkedIn, YouTube. And thanks again, Jamie and Andrew, for joining us. Hope you have a great rest of the day.
Thank you, Steve.
Thank you. Appreciate it.
Thank you.